Capital structure and weighted average cost of capital for firms. This is part 2 of this particular presentation. So far we have discussed how weighted average cost of capital is calculated for debt, preferred and equity components of the balance sheet of a firm. We found out that debt is actually cheaper, even though comparable amount of it can be paid to bondholders or to banks as interest as compared to stockholders. We also found out that equity is more expensive, but the easy option is that if the company is making losses, then we have the option to not pay dividends. Through this presentation, we're going to analyze the different sources of funding available to firms. So we're going to actually calculate the cost and value of debt, equity, and preferred stock with the context of cost and market pricing. We'll compute the value of debt, preferred, and equity as a proportion of the balance sheet. We'll compute the weighted average cost of capital using a company's capital structure, and then determine the feasibility of new projects based on this capital structure, utilizing the different decision-making rules that we've learned in cash flow analysis. So let's study an example. Our KMZ Airlines now wants to borrow more money for the creation of a hub. It currently has a total value of $600 million in debt and capital, i.e. different sources of assets. So these are different sources of assets. $200 million is in bonds, $200 million is in bank preferred, and $200 million is stocks and capital. Find out the weighted average cost of capital. To do that, let's go for the debt component first. So remember, the bonds cost are denoted by RD, rate of return on debt. It is nothing but the YTM of the bonds our company issues, KMZ Airline issues. So we plan to sell semi-annual coupon bond. The coupon rate is 8%, par 1,000, maturity 10 years, and let's assume the YTM is 9.576% annualized. So since it's semi-annual coupon, we'll have to make adjustments to this YTM. And so the question really is, RD is known, it's 9.576%. What is the price at which we issue this debt, and how many bonds should we sell? To do that, we just have to use a PV function in Excel and must make sure that semi-annual compounding is taken care of. So here, this Excel file I've kept it ready so that we can quickly go over this. So the payment is 8% divided by 2 because it's semi-annual, and 8% is an annual coupon, part of the face value. It is $40. The present value can be calculated as the PV function, PV. Now rate is the YTM, not the coupon rate. Coupon rate is fixed. So rate, it has to be a semi-annual rate, so divide by 2 times number of periods. Number of periods is 10 years times 2. The payment, each semi-annual payment is $40. So as issuers, KMZ Airline have to pay that money. They also have to pay the face value at the end of the maturity, and the type is 0. So this is the present value, or the price at which these bonds will be issued. Wow, it's $900 exact. How did we get that? I'm being sarcastic. Anyways, so the number of bonds that can be issued is the total size divided by the price per bond. So the number of bonds to be issued is it has to be shift control 1, 222,000 bonds, 222,220 bonds. And going back to the point now, so this will give us the price and the size. So we've determined both. Alternatively, there are some real life examples in which we need to calculate the rate if the price is given to us. Now here we can use the price to find out the YTM using rate function. So these are the two questions that we have. We have already solved the first. We're going to solve this the YTM part now. So let's do that now. So equals RATE, rate, number of periods is 10 times 2, semi-annual compounding. The payment per period that we are making is $40 every 6 months, and the present value that we received by the sale of these bonds is $900. the future value that we must pay out at the end, at the maturity, is $1,000, or the par value. The type is 0, and guess is my lucky number, 0.07. And this is a semi-annual rate. To create it into annual rate, we'll have to multiply it by 2. There you go, 9.576. This is the same as this. Okay, and to calculate the weight, we'll come back and do that. So what we've learned is this can be done backwards as well. So the rate of debt or the cost of debt can be found out using the rate function in Excel. Going back. So now let's move on to preferred stock, the component of preferred stock. Remember, preferred stock is perpetuity, just like stocks. However, the dividends are fixed. So the pricing of preferred stock is just dividend divided by price. And let's assume that in our case, KMZ Airlines issues another $200 million worth of 2 million shares, $100 each. So the dividend is $11 per share for preferred. What is the rate of return on preferred stock? Going back to Excel. So first of all, the number of shares is the total issue divided by the face or the price. Face value or the price that it was initially issued at. That's 2 million shares. That's a lot of shares. And the rate is the dividend divided by the price of each share. That's the rate. So 11%. And it's fairly straightforward. So the book value is $100 and the rate is 11%. That is preferred stock. Now let's move to equity. The equity component cost of equity can be computed through two ways. The capital asset pricing model, the CAPM model, or Gordon's model of dividend growth. So let's look at each of them separately. First, we'll look at CAPM model. In the CAPM model, we know that rate of return on stock is E of RI, rate of return on expected return on equity is risk-free rate plus beta times risk premium, RM minus RF. So all we have to do is find out the risk-free rate, find out the beta, and multiply it by the risk premium. That's it. So RE is a return on equity, RF is a risk-free rate, beta is a beta, and market risk premium is RP, which is RM minus RF. That's a CAPM model. Let's do that through this example. So we already have these conditions here. RF is given as 5%, risk premium is 9%, beta is 1.2. So RI can be found as RF plus beta times risk premium. Done. 15.8% is the cost of equity. But wait, we have to find this through the Gordon's model or the dividend growth model. So what is the dividend growth model? It is rate of return on equity. Remember, P0 is D1 divided by R minus G. We've just rearranged terms in that formula. So return on equity is the dividend that we pay out after a year divided by the price today plus G. So remember, the plus G is outside the fraction. So G is the growth rate of dividends. That's important. So again, the conditions are laid out here. We have dividend div 1. It should be div 1. This is G. And let's find out the cost, rate of return on equity. So it is D1 divided by P0, $100, plus G, 15.8%. How do you find out the number of shares? Well, the total size of the equity divided by price per unit share, price of one share. It's 2 million shares. But the rate here is 15.8%. Notice how 15.8% is the highest of all three. In fact, if you recall, it is the highest among, it is still on the lower side. Industrials on an average per previous presentation gave a return on equity between 15 and 22%, sometimes even up to 25%. So this is very, very conservative. Okay, so now we have done all of this to find out the 15.8% in our Excel, and then we have done all of this to find out 15.8% in Excel. Now how do we combine everything? Let's combine it here. So okay, let's just lay out the theory. The adjusted weighted average cost of capital is value of debt times 1 minus tax rate times return on debt. value of preferred times return on preferred, value of equity times return on equity. So let's just do them one by one. First of all, you have to find the weights. Weight is the value of debt divided by the sum of the total value, which is 600,000, and we're going to fix that. Well, to fix that cannot be fixed using the software that I'm recording with. So $B, $2, colon, $E, $H, $2, $2. That seals it up nicely. It's going to be 33.3%. Copy that, paste the formula here, 33.3. They're all symmetrical, so that's why it's coming out to be 33.3. If, for example, this was not 200 million, let's say this was 250 million, then the value would change. 250,000. Yes. So look, the values have wobbled around now, right? So our formula is correct. The symmetry makes them all equal. Now, how do you find out the weighted average cost? So we know this is D by V, this is PS by V, and this is E by V. Now we'll start using them one by one. So let's start with D. D by V times parenthesis 1 minus the tax rate times the rate of return of debt. First part done. Second, PS by V times the return on preferred share plus E by V times the return on equity. That will give us the weighted average cost of capital for this particular, for KMZ Airlines, and it's 11.455%. To reiterate, it's the debt component, the preferred component, the equity component, all added up together, 11.455%. Let's move on. What is the implication of this? Again, the number was 11.455%. The implication is accept projects with IRR greater than 11.455% on any incremental cash, any new projects, or use the discount rate of 11.455% to compute NPV for any new projects that are being considered. Anything that's giving you a negative NPV means that the rate of that project is not good enough. Okay, let's look at this first of all. So now this is a separate example. Let's assume KMZ Airlines now has a balance sheet that looks like this, and we're going to assess a cash flow, a project with cash flow like this. So let's go back to Excel. The sheet is ready. So all we have to do is first step. So we have this current assets, long-term assets, 1,000 million or $1 billion. Current liabilities are 100 million. Long-term bonds, slightly modified from the previous example. Bonds are still 200 million, but now we have loans. Loans are at 7%. Bonds still gave us 9.58% as we just computed, but now we also have loans, $150 million. We have preferred stock, 200 million at 11%, and owner's equity it's 200 million at 15.8%. But wait, we also have retained earnings of 150 at 15.8. So the weights are going to be slightly different. It is going to be this 100 divided by $D, $10. $D, $10. That's the weight. So the weight of current liabilities which were borrowed at 4% is 10%. The weight, I'm just doing control D now. Weight of long-term bonds, 20%. Weight of loans, 15%. Weight of preferred stocks, 20%. Weight of owner's equity, 20%. Weight of retained earnings, 15%. If these values change, for example, let's make this 250, the weights will adjust, right? So this is the power of Excel. It makes things automatic. Formula, you don't have to calculate them 55, 60 times. As soon as you adjust a number, make this 300, everything itself takes care of itself. That's the beauty of Excel. Okay, the next step. What is the WACC? To find out the WACC, it's really very simple now, because it is nothing but the sum product of the weights and the costs, and we're done. So shift control 5, alt H0, alt H0, alt H0. We'll go to 3 decimal places. So the weighted average cost of capital is 11.095. We'll show you that in here. See, the weighted average cost of capital is 11.1%. It is so easy to calculate, but in real world, these data come from various sources. Current liabilities will come from the treasury. Long-term bonds will come from merchant banking. Loans will probably come from corporate credit department. Preferred stock will also come from merchant banking, or whatever the division in the organization is. Owner's equity and retained earnings will come from the accounting department. So these are not easy to obtain in the real world. Now let's have this project to be evaluated. Okay, so already the cash flows are laid out. Let's explain the cash flows. So investment initially is a $9 million investment. Alt O E, let's just put them as a context, a number and then 0 decimal place. Please use the 1000 separator like that. And so we'll just make it for all. Control Y and Control Y. We just had a little bit of fun. So unlike other projects, we just put in another $1 million of investment at the end of year 5. So this is T3, T4, T5 at the beginning of year 5. I apologize. No, this is beginning of year 1, end of year 1, end of year 2, end of year 3, 4, 5, T6, T5, T6, T7, and T8. So it's an 8-year project. And the initial investment that we've made here is both in net working capital as well as the fixed investment. So $9.6 million. The $600,000 is net working capital change. So it is temporary. It gets recouped by the end of the project. When the project is wound up, net working capital is disinvested right there. So the real investment, therefore, that we've made initially at least is a $9 million. So we know the weighted average cost of capital of this company is this. Now, if we were to be fancy, let's just do the standard way. We should not assume too many complications for now. So NPV at the weighted average cost of capital's rate, and then these cash flows plus the initial cash flow. So NPV is positive. Is the IRR following suit? Let's see. IRR of all of these, and let's just guess 0.07 because it's my lucky number. 0.07. All right, so it's 13.2%. Looks good. It's better than the WACC, so we accept the project. One last thing, the profitability index. It is the NPV per unit initial investment that we made in capital. Okay, 8.4%. So decision looks pretty unanimous, pretty straightforward. Accepted. No complications at all. What we've learned is first find out the weighted average cost of capital, and then evaluate a new project at the cost of that weighted average cost of capital. And then if it's a positive NPV, then accept a decision, a project, or else move on to some other project. Going back, so that those results are summarized in the table here at the bottom. WACC is given, the NPV is given, IRR is given, and the profitability index is given. To conclude, debt financing primarily occurs through banks and bond markets. Cost of debts must be adjusted with the tax rate. Equity financing through new shares or through retained earnings, only 2 ways. Cost of equity is based on 2 ways, CAPM model through security market line, SML, or Gordon's dividend growth model. Hybrid is basically preferred stock, and it's treated as perpetuity. So the rate of return on preferred stock is dividend divided by price. So we use a perpetuity valuation. Value of a company is the value of debt, equity, and preferred stock. Notice how we've utilized concepts in Chapter 5, Chapter 6, all chapters: bond market, stock market, present value, cash flows, an NPV, IRR, risk management. Everything comes together in this chapter, in this discussion of weighted average cost of capital, because this is big. A company must look at all the aspects of corporate finance in order to evaluate anything new that it's trying to take on as a new business proposal. So cost of debt, which is adjusted by the tax rate, comes from the accounting department. Security market line and beta comes from risk management. Same beta from project, we need higher returns than what we have. Therefore, we use risk-adjusted weighted average cost of capital for the computation of net present value and internal rate of return. If NPV is greater than 0, the project is profitable. If IRR is greater than WACC, it's also profitable. And that is the end of discussion of capital structure. It's also the end of discussion of corporate finance. Thank you for all your patience. And thank you for listening.